The market has been called many things: cruel, irrational, casino, and all those terms aptly apply. However, the term we should apply to the stock we're discussing today is confused. The market really doesn't seem to know what it wants from this company. While the AI revolution rages forward, pulling software giants and startups alike along with it, this software giant has been beaten to the ground. Adobe, ticker ADBE, has lagged a bit this year, and today we're going to find out how good a buy this stock really is. Welcome to The Quality Investor. Today we are discussing software behemoth Adobe. This company has been growing crazy in the last 10 years. And based on those earnings just last week, it hasn't seemed to slow down a bit. So why is the market being so cruel? Why is the market so confused about this mega free cash flow compounder? We are going to answer those questions in today's video. We're unpacking the earnings report and looking ahead at what may be for Adobe. And before we do that, if you enjoy content like this, please hit that like button and subscribe to the channel. First, we want to understand why Adobe has been so down year to date, and especially after last week's earnings. Looking at this chart here, we can see Adobe is down 10.2% year to date. However, Adobe has shown some strength in the first month or so of 2024, reaching a high of $634.76 on February 2nd. But then its slide started for the next 2 weeks before the bears took control on February 15th. Looking at the bottom of the screen here, look at that huge uptick in trading volume. Over 10 million shares traded on February 16th alone. There was also this big drop from 590 down to 546 on that Friday. So what happened? Well, OpenAI announced Sora, their AI model that generates pretty amazing video scenes. Apparently, that's the end of Adobe. I suppose nobody will ever create and edit their own videos ever again. It's all AI now and forever. We'll come back to this point. But then earnings came out last week on March 14th, post-market. The next day, the stock went from $570.45 all the way down to $492.46, a 13.7% drop. So, what has happened this year? There's an excellent article that was published on Sunday, March 17th in Yahoo Finance called "Did Adobe Just Signal a Red Flag for AI Growth Stocks?" This briefly mentions what I believe to be the reason for the earnings drop last week of over 13%. Adobe's Q2 fiscal 2024 guidance was weak, and the company chose not to give an update on full year guidance, whereas it had given fiscal full year 2024 guidance on its Q4 fiscal 2024 earnings call in December. The market hates uncertainty, so it's no surprise why the bulk of the question and answer session consisted of analysts obsessing over quarterly results and fiscal 2024 performance instead of Adobe's long-term investments in where the company could be 3 to 5 years from now. I do agree that Adobe not releasing its full year guidance did spook the market a little bit after the earnings. However, to me, that's the market being a little bit irrational. And as some of the other things in the article state, we'll see why the market, I think, is a bit confused on what to do about Adobe. And this also touches on the point with OpenAI and their Sora release in February. You see, Adobe released users of Adobe Firefly through Creative Cloud and Adobe Express have already generated 6.5 billion assets like images, vectors, designs, and text effects. So Adobe's already in this AI race. But what really caught my attention is this next sentence. Adobe reported record new commercial subscriptions in Creative Cloud and teased new products for Adobe Express with Firefly for mobile, Firefly services, and an AI assistant for Adobe Acrobat. So Adobe is certainly not way behind in this AI race, even if what OpenAI has released looks pretty damn cool. But what Adobe is doing is they're getting more and more users into their ecosystem, and they're going to start tweaking that AI to see what the users really want and then try to monetize those users as we go along here. On the earnings call, Adobe clarified that it is focused on acquiring as many users as possible. The idea is that with good customer acquisition and retention, Adobe can monetize its user base over time. Next, looking at this CNBC article released after the earnings, Adobe shares slipped 10% on soft sales forecast. And again, I think this is why the market is a little bit confused. Once I show the earnings report and the forecasts, they're pretty much in line with what they've been doing the last few quarters. Anyways, this article states, meanwhile, in February, OpenAI announced Sora, which can generate a video based on a person's written description. Adobe will work with OpenAI around Sora, David Wadhwani, president of Adobe's digital media business, said on the earnings call. You're going to see us obviously developing our own model. You're going to see others developing a model. All that creates a tailwind because the more people generate video clips, the more they need to edit that content. And to me, that's a very telling line. Adobe is an editing tool. OpenAI can generate amazing images, but they're not editing software. Even if a user comes in and generates some pretty amazing videos from OpenAI, they will need to edit that. And Adobe is at the leading edge of editing software. So I do believe the market is having a pretty big knee-jerk reaction around OpenAI and Adobe's supposedly weak earnings forecast. And speaking of that earnings release, here is that press statement. So Adobe drove record Q1 revenue, demonstrating strong momentum across Creative Cloud, Document Cloud, and Experience Cloud. The CEO goes on to state, we've done an incredible job harnessing the power of generative AI to deliver groundbreaking innovation across our product portfolio. And Adobe is certainly bullish on itself. As the CFO states, Adobe's Q1 results and record RPO reflect strong customer adoption of our innovative products and services. Further stating, as a result of our strong trajectory of growth and profitability, we are announcing a new $25 billion share repurchase program, which demonstrates Adobe's continued commitment to returning capital to our shareholders. I do like businesses that do share repurchase programs. However, it's important to remember that a company should do it not to artificially boost their earnings per share, but to do so when their earnings are already strong and they're growing organically. And as we'll see here, Adobe is certainly growing organically. Looking at some of the highlights here for this fiscal quarter, you can see Adobe had revenue of $5.18 billion, and that's a 11% year-over-year growth. And the diluted earnings per share was $1.36 on GAAP basis and $4.48 on a non-GAAP basis. The difference is large for one reason. Adobe was set to acquire a design software tool called Figma, and that deal fell through. And because of that, Adobe had to pay a $1 billion termination fee to Figma as a result of that deal collapsing. We'll look at the income statement here in a second, but you can see operating income for the first quarter was $907 million, which is a bit below what they've done historically. However, they did generate $1.17 billion in cash from their operations. So looking at their income statement, here's that big revenue jump, $5.18 billion over the $4.6 billion from the 3 months into last year. And then here's that $1 billion termination fee. You can see that's a one-time event. So in this case, it's appropriate to really add it back to get a more accurate look at the actual earnings of Adobe. And that did affect their operating income, $907 billion versus the $1.586 billion last year. So adding that $1 billion back to the operating income, that'd be $1.907 billion. So you can see operationally, they actually grew their operating income by 20% year over year. And of course, you can see down here, their diluted earnings per share is $1.36 over $2.71 from last year. Again, adding that back in, that $1 billion termination fee, you're going to get a diluted earnings per share of $3.55, which actually amounts to 31% growth year over year. So like I said, Adobe is growing their earnings quite organically. One downside, however, is that termination fee was a cash expense. So they only generated $1.17 billion in operating cash flow, and deducting out the $37 million in property, plants, and equipment, that gives us $1.137 billion in free cash flow. So it's a bit of decline from last year. Last year's free cash flow saw the $1.69 billion in operating cash, less the $101 in CapEx, resulting in $1.59 billion in free cash flow. One downside to Adobe, however, is they are really upping their stock-based compensation. It's 451 million in this quarter as opposed to 461 in the same quarter last year. It is a bit of a concern because that has a dilutive effect on the shares outstanding for Adobe. And you can see that effect here in these cash flow charts for Adobe. So going back to 2009, the free cash flow is the yellow bar, and you can see that very strong growth that they've had. In the last fiscal year, 2023, they had 6.9 billion in free cash flow. Now looking at this bottom chart, you can see the adjusted free cash flow. I'm backing out the stock-based compensation, and this is on a per share basis here. You can see way back in 2009, their stock-based compensation is 32 cents a share. And fast forward to today, that stock-based compensation is $3.74 a share. And that results in a 25% adjustment for their free cash flow to account for that stock-based compensation, which you can see has started to trend upwards in the last 3 years. So remember that the market was really upset that Adobe didn't issue a full year 2024 guidance. So let's take a look at what they are guiding for next quarter, however. So total revenue at 5.25 billion to 5.3 billion. So when they did issue the 2024 guidance last quarter, they stated that they expect 21.3 billion in revenue on the low end. Dividing that by 4 gives us 5.325 billion averaged for the 4 quarters of 2024. And you can see the high end of this quarter's guidance slightly below that at 5.3 billion. So in my opinion, that is the primary reason for the large drop that we saw in the market. I do think it's important to note, however, if they do hit the low end of that 5.2 billion here, that's still a 9% year-over-year growth in revenue. Going back to that Yahoo Finance article, there's something I want to point out here. So it says that Adobe didn't signal a red flag for AI growth stocks, but it did remind investors of where their focus should be, which isn't on the next quarter or year, but on how AI enhances the overall investment thesis. And I think it enhances it very well because Adobe can directly monetize the people already in the Adobe ecosystem. Adobe has a clear, straightforward way to monetize AI, which makes it one of the more intriguing long-term plays out there. And one more thing that really caught my eye in this article was this. For fiscal year 2025, analysts expect $20.30 in earnings per share, which would mean price to earnings ratio of 24.6. But that's based on full year earnings 7 quarters from now. Now, as you'll see in a second here, when I show you my growth projections, that $20.30 earnings per share is very optimistic. My projections are a lot more conservative. So keep that in mind as I reveal what I believe the true value of this stock really is. And looking here at my projections, you can see my year 1 revenue projection here is 21.5 billion. It gives us an earnings per share of $11.93. My year 2, which equates to the fiscal year 2025, I have it at $13.28. That is well below what analysts are projecting. So I do think my analysis here is quite conservative. I'm projecting 10.69% compound annual growth for the next 10 years for revenue, 11.8% for operating income, 12.1% for net income, 14.5% for earnings per share growth, and 12% free cash flow compound annual growth. You can also see it's well below what they've been doing historically over the last 10 years. So again, keeping the theme of being very conservative in our projections. Looking at the exit multiples model real quick before I go to the full valuation, I'm using Microsoft, Oracle, Synopsys, and Salesforce as my comps for Adobe. That gives them an average PE of 50.9. Comparing that to Adobe's current PE of 43.9, that's an exit multiples price of $601.93. So coming over to that investment summary page here, once we discount our free cash flow for Adobe, that is a discounted cash flow price of $630.26. I already pointed out the $601 exit multiple price. And looking over here at some profitability metrics, you can see the gross and operating margins are well above their 5 and 10 year averages. And management has done an excellent job on their capital allocation. You can see the return on invested capital is at 26.9%, and the return on capital employed is at 31.45%. These are both above their 5 and 10 year averages, and I do believe that they're very indicative of what sort of return you can expect long term based on how the management allocates their capital investment. So we can see here the current share price closed today at $519.14. Our valuation average comes out to $620.35, which gives us a 19.5% potential upside. I'm using a 10% margin of safety. I believe Adobe is a very solid, safe company. And that gives us an acceptable buy price of $558.31, or a desired PE here of 47.2. So despite that market skittishness that we've seen out there with Adobe, Adobe is a strong business with a wide economic moat and will provide solid growth for many more years. And until Adobe starts showing issues with its core business and fundamentals, this sell-off, it's a pretty good time to start loading up on Adobe. Some of these issues would be a steep loss in their subscribers, new editing software, at least as capable as Adobe, and remember, OpenAI, it's not an editing tool. Or for some reason, Adobe can't figure out how to monetize its AI offerings profitably to its current users. So with that, thank you for watching today's video and happy investing.